Well, I'm delighted to be conducting this very interesting conversation with Akhil here. Last time as well, Akhil and I had a very interesting chat on a different topic. But this time the topic is extremely interesting, is to, select the right product that would align the gap between, returns and expectations. Just to, set the context, of course, we've seen a very strong bull run taking shape over the last 5 years, post-COVID especially. But if you look at the last 1 and 2 year returns, they have been extremely strong, right? Just to borrow a quote from a guest on Kaizad's panel earlier this evening, he said that in a bull market, everything seems to get amplified, That also, includes return expectations, right? Given the fact that we've seen such a strong up move, the markets have climbed all the walls of worry. Very recently, the election results, we had the tax tweaks in the budget, we had global volatility, US recession scare, but we have staged a very smart comeback, right? And we're just about 2% away from all-time highs. So going forward, do you think there's a need to firstly temper expectations, at least for the medium term? Do you think the gap between expectations and returns will widen from here?
Yeah, so certainly, given where we are and the kind of returns we have seen in the last 1.5 years or so, it always makes sense to taper down the expectations of returns. But what I hear from all our dear partners is that the moment you try to taper down the returns, investors don't want to hear, right? So they still are, in this awe of seeing higher double-digit returns, and their expectations are very, very big. But yes, I think as rational people from the financial services world, these are the times where I think risk management plays an important role in return management. So at this stage, we have to be, and all the managers have spoken out here in the previous sessions, very important for all of us to assess the risk in the client's portfolio across market cap buckets, thematic funds, sectoral funds. And if at all clients are sitting on a lot of money, then it makes sense to rebalance the portfolio. Remain in equities for long term. It's the best compounding machine. But rebalancing at regular intervals from, kind of euphoric opportunities to somewhere where there is a better value, always will, protect your downside in the event of any kind of risk. The other thing, actually, when I meet all my distribution partners, honestly, on a lighter note, I think more distributors are now waiting for the corrections to happen than actually they're waiting for the markets to go up. The only thing is, whenever there is a slightest reason for correction, it just gets bought into very fast, because for every 100 rupee which is getting invested today, there is 500 rupee which is waiting to come inside. So you look at the election result day, 8-9% correction bought into. You look at the budget, 8-9% correction bought into. Last week we have seen the yen carry trade and the US economic data, some amount of volatility. And this week is like, every day you are seeing a new high. So we are in a complete different trajectory. But yes, at our level, we need to be more wise and, try and take the best decisions.
So, as I mentioned, the markets have climbed all the walls of worry. What is one big worry, according to you now? Would valuations be a worry?
Yeah, I think through the last 3 years, we've been talking and hearing all about valuations. So valuations definitely is a worry. I think while I'm more on the business side, but I talk to the managers all the time. And I think clearly fund managers really have a task on hand in current times. Whether they have to take cash position or they want to rotate the sector from the ones where, valuations are expensive to coming to more safe havens, which are far and few, honestly. But still, wherever you find relative valuations more comfortable. Honestly, it's a phase where it's not like the buy and hold phase. You have to be on the treadmill, continuously assessing pockets of opportunities, pockets of safety. You have to be very, very agile, very, very active in current times. And then eventually it is all about relative returns, right? So as active managers, we need to do well in good times and we need to do well in bad times. So keeping that in mind, I think, obviously in India, while the macros are doing very well, but micros maybe this year might be a little more somber. From that perspective, your short to medium term return expectation should be lower. But there are a lot of risks which are outside of India than actually within India, right? So if something sparks from outside, whether it is politics or geopolitical or, something happens in US in terms of elections or something like that, I think those are more of the worry factors than actually what is happening here.
Right. So what should the best investment approach be now? Should one be an active investor or a passive investor?
So you should be a mix of active and passive investor. I mean, if you're talking about active funds and passive funds?
Active.
Yeah. I mean, so investors, I think, like I said, I made a previous point that this is a time where at this stage you need to be a little bit more active. You need to, as investors also, you need to see where your investments have gone in the last 3 years, where you made significant higher returns. And if you talk about small caps and mid caps, clearly we know that you're sitting on very high premiums, and obviously at this stage you need to go more towards safety, and large caps from that perspective is offering that safe haven. So it's good to book your profits where you made a lot of money, move towards large caps, move towards flexi cap funds with higher large cap exposure. I think it is about time where some kind of rebalancing needs to be done. 100%.
And in terms of asset allocation, what should the strategy be? Would you be, an investor in gold? And if yes, which is the best way to invest in gold, especially after the budget, where tax tweaks were announced, right? So, would you go for a sovereign gold, fund, or would you go for ETFs, vis-a-vis physical gold?
Yeah. So for many decades, we've been taught in our fraternity that gold is something you have to stay away from. Gold is something where you will get inflation plus minus, that kind of returns. But I think over the last 3-4 years, or maybe last 5 years, I think gold plays an important part in terms of asset allocation. Not gold in terms of jewelry, etc., but yes, gold in terms of as an investment product. I think 10% at all times being in gold and playing between 10 and 20% depending on what kind of a market cycle you are. But gold does play a very important role. Anytime there is a black swan event, there is higher amount of uncertainty, any political event, it does give you a very nice cushion. And these days you are also seeing after the custom duties coming down, etc., there is a demand for gold. I mean, you see all the jewelry companies are doing extremely well. So I would suggest that, yes, gold should be there, irrespective what return is coming out of it. There will be some years where gold will outperform, some years gold will underperform, but you need to have a static allocation between 10 and 20% to gold. The best way to play a gold is, if you want to buy physical, buy bricks, that's it, or you buy the ETFs, you buy the sovereign bonds. I would prefer to have sovereign bonds or go for ETFs, or there are index funds also available. And the next best commodity is silver. So you have a combination of gold and silver also available. So those options and those solutions are available, and we should have.
Right. Have debt funds lost their appeal, especially since the indexation benefits have been removed?
Yeah, I mean, clearly the numbers are showing that the debt is completely dead, right? Obviously the tax thing, post the tax changes, I mean, you're at a marginal rate of tax now. So it's an asset class which typically tends to give you higher single-digit returns, and then you're taxed at the full rate. Obviously, post-tax, post-inflation, what is your real return? And people are smart enough to understand, and I think a large part of that liquidity is also shifted towards equities or hybrid funds or multi-asset funds from that perspective. But for now, the numbers do suggest that fixed income, at least from retail investors' perspective, we don't see too much of flows. Although I think there is a good opportunity coming around to make some money in fixed income as well. But yes, for now, the numbers are not encouraging.
I also want to get in your thoughts on alternative investments, right? Where do they fit in within an investor's overall portfolio, and how should an investor really look at the risk-reward vis-a-vis traditional investment?
Yeah, so that's my favorite subject, right? Talking about alternative, because at Motilal Oswal, we have a pretty large book on the alternate side. Now, for a very long time, we have been the biggest proponents of mutual funds, right? And mutual funds is probably the best vehicle for anybody to invest. But what we have seen in the last 10 years is that as the markets have produced a lot of return, as the country has done well economically, wealth is getting created, there is prosperity. So we have seen that number of billionaires in our country is actually moving up. Number of people who are over 1,000 crores are now running in several thousand numbers. You have over 700,000 people who have a net worth of $1 million and above. So people have made money, and I mean, look at this. I mean, somebody had put 50 lakhs 10 years back, today might be 2.5 crores. 10 years back, 2.5 crores, today would be maybe 7-8 crores, and so on and so forth. So as people have made more money off late, what we have seen is that there is increased appetite to take more risk and look at more asset classes, to get more experience into stuff which is different than your conventional mutual funds. So you look at the numbers, the kind of AUM which is moving up on the private equity side. And the whole category 1, 2, 3, category 1 and 2 AIFs, from nothing in 2012, it's almost 8 lakh crores, 9 lakh crores. And that's all the money which is sitting on VCs, private equity, real estate, right? So there are a lot of people who are putting a lot of money out there. So I feel that those investors who have reasonably large surpluses to invest can take 40-50% exposure to alternate assets. Even on the long only side, you have different flavors available on portfolio management services, right? You have different flavors on the category 3 AIFs. So your plain vanilla routine products like a large cap, mid cap, multi cap, flexi cap, you can play on the mutual fund side, but a lot of differentiated thematic products can be experienced on the alternate side. So, and I mean on the debt side also now you have a big opportunity on the private credit space. You can participate to something like fixed income kind of return through the real estate funds on the AIF. You have logistic funds available. You have infra yield funds available. So the whole plethora of options which are available across equities and fixed income, it's really very exciting. So I feel that audience in this room, I think there is a big opportunity outside of mutual funds on the alternate space for your investors who can put that kind of money. But big space.
Right. Akhil, we are running out of time. Just one last question. Globally, tech stocks have been doing phenomenally well, right? Look at NVIDIA. It has had a dream run. For an individual investor, he still has the option of investing in these stocks via brokerages, etc. But for the mutual fund industry to invest in overseas market, there was a limit of $7 billion, which got breached 2 years ago, and the RBI hasn't really come out with or extended that limit yet. Have you guys made any recommendations to the RBI? Would you have a timeline as to when RBI will increase that limit? How are you viewing this entire global tech stock rally and the fact that mutual fund industry is sitting out of it?
Yeah, so on an ongoing basis, we are liaising with government officials, RBI, SEBI, making our recommendations to increase this limit from $7 billion to something $3, $4, $5 billion. Of late, we are seeing again the demand for US coming up. So eagerly waiting, no clarity, honestly, completely clueless. But we are seeing a lot of investors actually using other platforms to buy into the stocks of their own choice. So there are many platforms now available where you can buy stocks. In fact, there are, I think, 1 or 2 funds which have been launched on the GIFT City where you can use the LRS limit and invest into US or emerging markets. But at this stage, obviously, not too much of clarity here.
Right, of course, we'll all wait for the clarity, but of course, I think we are running out of time. We are completely out of time, rather.
Actually, last year also, this was the same issue. The fireside chat has become more like a, what do you say, what do you call that?
Rapid fire.
Rapid fire.
I don't have a hamper to give you. I'm really
so next time I'll take the first spot.
But yeah, it was lovely chatting with you. With that, I would like to hand it over to Sonal to take the evening forward.
Thank you so much.